So on April 20th, 2020, something happened in the financial markets that was, well, supposed to be completely impossible. The price of a barrel of oil, it didn't just fall. It crashed straight through the floor and just kept on going. All right, let's dive into the absolutely wild story of how a global commodity basically became toxic waste overnight. I mean, that sounds like a totally ridiculous question, right? But on this one single chaotic day, a handful of traders, including a 22-year-old kid from Texas, made hundreds of millions of dollars by betting on the unthinkable. Their story, honestly, it just shows you how bananas our modern markets can get. And this is the number at the very heart of it all. Negative $37.63. That was the final price for a barrel of oil. Think about that. Sellers were literally paying buyers almost $40 just to haul the stuff away. So the biggest question is, how on earth does something like that even happen? To really get that negative number, we've got to rewind the clock a little bit. See, this crash didn't just happen out of nowhere. All through early 2020, the pressure on the oil market was building and building, getting ready to just pop. I mean, look at how fast this all went down. We start the year at a totally normal $60 a barrel. By March, it's cratered to $40. And even on the morning of April 20th, when it opened around $20, most people were thinking, okay, the worst has to be over. Oh, they had no idea. And this is where we meet the people at the center of this storm. While the rest of the world was grappling with the pandemic, you had folks like Sam Shaw and Cody Young staring at their screens, seeing what they thought was the opportunity of a lifetime. The crazy part? They were on completely opposite sides of the exact same historic trade. This quote just perfectly captures what almost everyone was thinking that day. As the price was plummeting, past $10, then $5, then $3, traders like Sam Shaw thought they'd hit the jackpot. They started buying like crazy, thinking, there's no way this can go any lower. I mean, it's oil. It's a real physical thing. It has to be worth something, right? Okay, so to understand why they were so wrong, we need to do a quick breakdown of the financial thing at the heart of this mess, the futures contract. See, this wasn't about the price you pay for gas. This was about something way more abstract and way more dangerous. So, a futures contract is basically a bet. You're making a deal today to buy or sell, say, 1,000 barrels of oil for a set price sometime in the future, like next month. The key thing to get is you're not actually buying the oil yet. You're just buying the contract for the oil. Now, 99% of traders just want to do step 3. Buy the contract, hope the price goes up, and then sell it for a quick profit before it expires. But, and this is the part that blows everything up, if you're still holding that contract when it expires, you are legally stuck with step 4. You have to actually take delivery of thousands of barrels of real, sloshing crude oil. And that brings us right back to our story. The specific contract that was causing all this chaos was for May's oil delivery, and it was set to expire the very next day, on April 21st. The clock was ticking, loudly. Anyone still holding that contract when the market closed was in deep, deep trouble. Which leads us back to the big mystery. Okay, we get it. Traders were desperate to sell their contracts before they expired. But why were they so desperate they were willing to pay someone to take it? What was the fundamental problem here? Well, the answer wasn't on some trading screen in New York or Chicago. Nope. The answer was in the real world, in a tiny town in Oklahoma, where a massive physical logjam was about to cause a total financial meltdown. And here it is. The answer was shockingly simple. There was literally nowhere left to put the oil. All the oil promised in those May contracts had to go somewhere, right? And every single storage tank was already full. There was no room left at the inn. It was the absolute perfect storm. So Cushing, Oklahoma, that's the official delivery spot for this type of oil. At the exact same time, COVID lockdowns meant nobody was driving, nobody was flying, demand for oil had just vanished. So all this oil being pumped out of the ground was just piling up in Cushing's tanks. If you were stuck holding a contract, you didn't just own oil anymore. You owned a massive, expensive problem with nowhere to put it. The whole situation got so absurd that the media had a field day. Headlines like this one from Bloomberg went viral. Memes were everywhere, people joking that gas stations were going to start paying them to fill up their tanks. It didn't actually work that way, of course, but it perfectly captured just how bizarre the whole thing was.
Now, in any kind of chaos, you're going to have winners and you're going to have losers. And while a lot of people got totally wiped out, a small group of traders who actually understood the storage problem made an absolute fortune. And that, of course, led to some very serious questions from regulators.
The amount of money made here is it's jaw-dropping. A group of just 9 traders, nicknamed the Lone Star Lads, pulled in over $660 million. Our 22-year-old Cody Young, he was part of that group, and he personally walked away with $100 million. And on the flip side, you had traders like Sam Shaw, who bought in thinking it couldn't go to zero. They faced devastating, life-changing losses. Yeah, no surprise here. When a tiny group of people make that much money that fast, it tends to raise a few red flags. The main regulator, the CFTC, launched a bunch of investigations, looking into whether the market was illegally manipulated. And those legal battles, they're actually still winding their way through the courts today, so this story isn't even fully over yet. So look, the Great Oil Crash was a true black swan event, a once-in-a-lifetime thing driven by a really unique physical problem. But the ideas behind it, using derivatives to bet on wild price swings, are actually more relevant today than ever before, especially when you look at a different and maybe even wilder market. This really breaks down the shift, right? The oil crash was an anomaly, a freak accident caused by a real-world supply problem. But in the world of crypto, extreme volatility isn't an anomaly, it's practically a feature. Massive price swings happen all the time, and they can be triggered by anything from a single tweet to a new government regulation. And here's the key takeaway. The same tools those oil traders used are now super accessible for trading crypto. Things like futures let you bet on prices going down, not just up. And platforms like Coinbase even offer this with crazy high leverage, which means you can control a huge position with just a little bit of capital. We've seen this play out over and over, like with Ethereum, which doubled in value in just a couple of months, creating massive opportunities for people who are in the right position. The day oil went negative really taught us that in the financial markets, even the things we think are impossible can happen. It showed us how a problem in the real physical world can completely break the digital world of trading. So the question for us now is, where's the next big one coming from? Is another black swan hiding out in a traditional market? Or is it brewing right now in the super volatile, decentralized world of crypto? That's definitely something to think about.